Welcome back. I came back from the bathroom, came back from a call. So I always forget to, I should write it down. So back from bathroom, reading chapter, so finishing up chapter 1 for the role of financial statements. Okay, yeah, I think that's good. So just to recap, there's so business activities, there's going to be operating, financing, and investing business activities. And then investing activities, operating activities are day-to-day operations. So operating activities are day-to-day buying and selling of goods and services that the company uses to pretty much run a business, to be able to earn profits. That's what a for-profit business does. And then the investing activities are all of the activities, I guess, that a company participates in to be able to create more opportunities for operating activities. And then financing activities is just ways to actually find the money to run the operating activities and the investing activities. I think that's just a general idea of how all of these three are related to each other. And then I think the way that the authors represent fundamental valuation theory. Oh, I sneeze. Oh, okay. So the way they think about fundamental valuation is just by discounting cash flows, future cash flows, at the cost of capital. And then I think the point I'm on in this chapter is just the role of financial statements. So how financial statements don't show investors the actual cash flows of a business, but they do show you the relationships between the different accounts or different measurements of certain metrics within a business: revenues, operating income, net income. Those are probably the biggest ones. And they're not perfect. They're not going to be standardized across every company. All companies report things using GAAP principles, but they also have non-GAAP principles or non-GAAP reporting metrics as well. And so I think a really good valuation artist is able to really decipher these financial statements and really understand some of the relationships between different accounts, and also not just how they're calculated, but how one can affect the other. Patience. Okay. Right. Okay. So I think one of the big ideas is when you're thinking about looking at financial statements, this gives you a lot of really good information about what you need to know for a certain company. Because you could say, okay, Apple's trading at $300 per share. It currently has a market cap of $3 trillion. I'm not too sure if that's exactly right. I think maybe Microsoft is $3 trillion, but something along those lines. And the financial statements kind of give us a glimpse into why that is, and why companies like Apple are trading at really high valuations. So they'll tell us, in terms of the operating activities, how much profit that's generating, how much sales are being generated. And then the investing activities, the financial statements will tell us what Apple is spending their money on to create more cash or profitable opportunities in the future. And then financing activities, we can think about Apple. For financing activities within Apple's financial statements, we can see how capital is being raised and whether it's debts or equity, and then also some of the costs of those types of capital structures. So the most common ones I can think of are dividends and also interest payments on debt. But these provide us a good starting point, because without knowing the specific revenues, we can't predict any future type of revenue. Without a baseline, Apple's making $60 billion in revenue in 2024. Without knowing that, we really can't make predictions about Apple's revenues in 2025, 2026. We're just kind of guessing. The second role of the financial statements is to provide historical data on the cash flow implications of a firm's past business activities that may prove useful in forecasting its future cash flows. There's 3 steps that the authors think of equity valuation. Understanding the past is the first step. industry related. So some of these are key questions we need to ask, which is the business make, how does it make? Competition among managers limits the availability of such opportunities. Your business analysis should leave you with a clear understanding of the firm's business plan and some opinions about whether this plan represents a viable strategy for generating abnormally high profits. Reports on the periodic financial position and operating performance of the business. After long periods of time, many years, cash flows from the firm's operating. This problem arises because a firm's operating and investing cycles spans many years. The net cash flows to a firm over short periods of time provide a very nice cash productive asset for short term. The long run cash consequences of firm short term. Margin is the firm. Unfortunately, some firms choose to invest surplus cash flows in wasteful ways rather than making timely distributions. So, FC. It's probably VFC. So it seems like there's 3 steps within this valuation process. First one is being able to understand the past. Second is forecasting the future, and third is the actual valuation step. Okay, there's definitely it's Okay, so I actually kind of like the framework that these guys are using when it comes to the equity valuation analysis. They're really breaking down the valuation into 3 distinct steps. So you have, first one is just being able to understand the past, understand what the company has gone through, the history of the company, the history of the industry, and have that information locked and loaded, ready to go. Second is to be able to forecast the future. So using whatever information you've gathered, whatever you've understood or learned from the past of the company, the industry, and the economy, you can use that to really forecast what the company itself is going to look like in the next 5, 10, 15, 20 years, and also probably what the industry and what the economy is going to look like. And then finally, the last step is just actually doing the valuation itself. So once you have the past and the future together, you can combine the two so that you can figure out how much one should actually pay to invest this company based on what it's expected to make in terms of cash flows. So I think that's a really good framework to think about. So I finished chapter skimming through chapter 1 of equity analysis. Okay, so I think what I'm gonna do now is I'm gonna actually, let's see, it's like 30 minutes. I think what I'm gonna do now is probably go over to the Zeng Fund and then continue streaming on that, because I'm gonna stream on that for a little bit just so I can work on the equity valuation for VF Corp. That's something I've been wanting to do and wanting to finish for a while. Still haven't done that, so I'm gonna do that now, and maybe I'll come back to this. And what did I have on my? Or maybe review the concepts from the pre-class quiz. So I feel like there's a few concepts I want to review. One of them is p-values, r-squared. So I think r-squared is related to Pearson's correlation coefficient. It's just the square of that. But also, I think it's related to the mean squared error and the sum of squared residuals in terms of sampling and statistics. So that's why I titled this the stream review of basic statistics. But I think right now I have some fresh ideas in my mind with the equity valuation. I kind of want to just get started on that. All right, in that case, thanks for watching, and I'll catch you in the next one.